Wealthy families have been using charitable remainder trusts to completely eliminate capital gains taxes for 40+ years, while the average person has never even heard of them. I'm going to show you exactly how this works and whether you qualify. Let me start with a real scenario because this gets abstract fast. Imagine you bought Apple stock in 2010 for $50,000. It's now worth $3 million. You want to sell it and diversify, but if you do, you owe the IRS approximately $375,000 in capital gains taxes. That's 12.5% of your gains just vanishing. Here's what wealthy families do instead. They donate that stock to a charitable remainder trust. The trust immediately sells it. Zero capital gains tax. None. And here's the kicker, you still get income from it for the rest of your life. Let me break down the actual mechanism because this is where most explanations fall apart. A CRT is a legal structure. Think of it like an LLC or a partnership, but it's specifically designed for one purpose. You transfer appreciated assets into it, get a charitable deduction, avoid capital gains taxes, and receive income distributions. Here's the exact flow. Step 1. You identify an appreciated asset. This could be concentrated stock, real estate, inherited property, a business stake, anything with significant unrealized gains. Step 2. You work with an estate attorney to establish the trust. This is not DIY territory. You need an attorney experienced in CRTs because the IRS has very specific rules. Step 3. You transfer the asset into the trust. Legally, you no longer own it. The trust owns it. Step 4. The trust immediately liquidates the asset. Because the trust, not you, is selling it, there's no capital gains tax due. This is the magic moment. Step 5. The trust invests the proceeds. Now here's where income generation happens. The trust must distribute at least 5% of its initial value to you annually for the rest of your life. Some trusts pay more, some go to 8% or 10%. Step 6. When you die, whatever remains in the trust goes to a qualified charity. You set this up in advance. Now let's use actual numbers because percentages lie. You have $5 million in a concentrated stock position. It cost you $500,000 years ago. The unrealized gain is $4.5 million. Scenario A, you sell it normally. Capital gains tax, $675,000, assuming 15% federal plus state taxes. Net proceeds to invest, $4.325 million. Scenario B, you use a CRT. Capital gains tax, zero full $5 million reinvested. You receive 5% annual distributions equals $250,000 a year for life. When you die, the balance goes to charity. Over a 30-year retirement, Scenario A generates you roughly $5.2 million in distributions, assuming 4% growth. Scenario B generates you $7.5 million in distributions, plus you never paid that $675,000 tax. That's a $2.3 million difference for one strategy. But here's why wealthy families have been doing this for 40 years, and most people don't know about it. You have to actually want to leave money to charity. This isn't a pure tax dodge. There's a requirement. The IRS allows CRTs because they benefit charities. That's the entire point. You must designate a qualified charitable organization to receive the remainder of the trust when you die. This could be the American Red Cross, a university, a hospital, a religious organization, or a private foundation you create. So CRTs aren't for everyone. If you want to leave 100% of your wealth to your kids, this isn't the strategy. But if you're willing to give a portion to charity anyway, which many high net worth individuals do, a CRT becomes incredibly powerful. Here's the historical pattern I mentioned. In the 1980s, when capital gains taxes were higher, wealthy families used CRTs aggressively. Then in 1997, the Taxpayer Relief Act actually improved CRT rules. In 2003, when capital gains rates dropped to 15%, some advisors said CRTs were dead. They were wrong. In 2013, rates went to 20% plus net investment income tax. CRTs became attractive again. And right now, with the current rate structure and the possibility of rates increasing, we're in another CRT acceleration period. Families that have used these for 40 years have collectively avoided hundreds of millions in taxes. Let me address who actually qualifies, because there are income and asset thresholds. You typically want appreciated assets of at least $500,000 to $1 million minimum. Below that, The legal setup costs don't justify it. You should have significant unrealized gains, at least $250,000 in embedded gains. And you need to be comfortable with the charitable remainder requirement. There are actually two types of CRTs: Charitable Remainder Unit Trust and CRAT, Charitable Remainder Annuity Trust. The difference comes down to whether your distributions are percentage-based or fixed dollar-based. Most high net worth individuals use CRTs because they're more flexible. Now, how does a CRT integrate with the rest of your tax architecture? Many high-income earners combine CRTs with other strategies. Some use a CRT to liquidate a concentrated position, then immediately set up an LLC to hold newly acquired real estate and depreciate it. Others use a CRT to free up capital, then fund a life insurance policy through an ILIT to replace the charitable remainder with a tax-free death benefit for their kids. You could theoretically set up a CRT, use the proceeds to fund a 401k if self-employed, and backdoor Roth conversions, and then use remaining capital in an HSA-funded strategy. The point: CRTs aren't a standalone move. They're one piece of a coordinated plan. Let's talk about implementation timeline, because this matters. From decision to having a funded CRT typically takes 6 to 8 weeks if you move quickly. You'll need: Week 1-2, consult with a CRT experienced estate attorney. Get quotes. This costs $2,000 to $5,000 for basic setup. Week 3-4, attorney drafts the trust document. You review it. IRS has very specific language requirements. This can't be sloppy. Week 5, you sign and notarize. The trust is now legally established. Week 6 to 8, you transfer the asset into the trust. This might require updating brokerage accounts, deed transfers, or corporate filings depending on what you're transferring. Once funded, the trust immediately files an EIN and the trustee can liquidate the asset. You claim the charitable deduction on your tax return. This is where many people get stuck because the math is complex. The IRS publishes actuarial tables that determine your deduction based on your age, the payout percentage, and interest rates. A good attorney or tax advisor calculates this precisely. Common mistakes that trigger audits: undervaluing the asset, miscalculating the charitable deduction, not using an independent trustee. The IRS wants to confirm you're not getting preferential treatment, and failing to file the required Form 8283 or Form 1041 timely. Here's what most advisors won't tell you. CRTs have become more popular lately because of 3 things. 1. Capital gains rates are high. 2. Inflation has driven unrealized gains higher across portfolios. 3. People are finally talking about them. The veil of secrecy around wealthy family strategies is lifting, but they're still underutilized because they require professional help. You can't open a CRT on a tax software platform. You need an attorney, a tax advisor, and often a trustee. That friction keeps most people away. For high-income earners and business owners, though, that friction is worth eliminating because the tax savings are substantial. The final piece: long-term thinking. A CRT is not a short-term maneuver. You're locking up assets for your lifetime. The distributions you receive are partly taxable income. The charitable remainder goes to a charity after you die. If you're someone who needs access to your principal or who absolutely must pass everything to your children, this isn't your strategy. But if you're sitting on appreciated assets, want to generate income for life, want to eliminate a massive tax bill, and are comfortable directing some of your estate to charity, CRTs have been the wealth preservation strategy for 40 years for a reason. Now you know why. If you're in this position, the next step is a conversation with a CRT attorney. Get them to walk through your specific situation. The math will either make sense or it won't.